Over the past month or so, financial markets have been all over the place, with some amazing days and some of the worst days on record. And during those moments, I've noticed that a lot of financial influencers who lack any sort of professional qualification have been telling their followers that when the markets are low, it's a great time to buy. This raised a lot of interesting questions for me, not only because it contradicts what a lot of the advice they've been giving their followers, but also because it lacks any logic. Let's dive into it. Elliot from abroad in here with some quick thoughts. Back in April, when the markets were in a tailspin, a lot of financial influencers came out and said, well, the markets are down and here's a great buying opportunity. A lot of these influencers have long talked about the value of ignoring the markets and just sticking to your passive investment strategy, following what's known as dollar cost averaging. And that's where you periodically go out and buy your investment portfolio, usually investment funds, on a particular day of the month. And regardless of what the market's doing over time, you're going to come out on top, because some days the markets will be down, other days they'll be a bit higher, but they will average out, hence dollar cost averaging. If you're buying into an index fund, you're buying low and buying high on the components inside of it, because a lot of time those components aren't going to be doing the same thing. Some of them will be a bit lower, some of them will be a bit higher. They're all saying things were cheap now, so you should go out and buy. Well, okay, but how do you define cheap, right? Is it a certain price point? Is there a metric you're looking at, like the price to earnings ratio? What's your definition of cheap? Because if you don't have that definition, you have no clue if it's a good deal or not. And more importantly, by doing this, it makes you an active investor. And if your whole goal is to be a passive investor and ignore the markets, all of a sudden you're starting to try to time the markets to take advantage of a deal that you probably haven't measured out anyways. If you want to do some opportunistic investing, that's fine. You just need to define what exactly is the opportunity that you're taking and how you're going to measure it. Any sort of investing you do needs to be done with a purpose. Again, that's why we really like the SMART financial planning method, just because it helps us define what our goals are and how we're going to reach them. Right, that's it for me from this probably entirely too long for social media video. Hope you like it. Give us a follow. Let me know your thoughts and have a great one.